Hello and welcome back to the channel. My name is Zach Collins and this is Financial Education. Today what I want to talk to you about is a different type of asset that you can buy and the different ways that they provide a return. Specifically what I'm going to be looking at is stocks, ETFs. Now I've already done a video on ETFs, so make sure you do check out my channel for more information on this. I'll just do a brief overview and do a bit of a further dive into the other ones. Bonds, and finally, property. Stocks are the most diversified type of assets that people tend to hold in their investment portfolio. So whenever people say that investing in stocks is a bit risky and it's a gamble, they're right. They're also wrong. Now, not always, but a lot of the time people say it's risky and a gamble because basically they put money into some random mining penny stock that their mate at a barbecue mentioned just in passing. The way I like to think about it is taking the price and speculation out of the investment. All companies have shares. It's really only the large national ones that we can actually buy into. Now, the more you know about the business itself, the less likely you are to lose money by selling at a time when things aren't necessarily going that well. Stocks are in literally every industry, everything you can think of. So you can invest in a company that sells you the clothes you wear, the food you eat, the bank you keep your money with, the company you work for, if they're listed, the company that provides your phone reception, the company that sells you your phone. You guys get the point. There are a lot of companies that we use in our everyday life, and by investing in stocks, basically we have some ownership of those businesses or their competitors. Now, before you invest in any company, in order to get the best returns, it's always good to look at the fundamentals and calculate their value. Now, there are so many different ways to calculate the fair value of a company. And look, that's a video in itself. And this is done through, looking at balance sheets, looking at the revenue, looking at the expenses, looking at the long-term potential profitability of the company. Look, now, don't get me wrong. You can do all the due diligence you want. Some companies will still go under. There's always a chance of, losing money, but it is a lot lower than if you just pick some random company. The way you actually get a return through investing in companies is two ways. By the stock going up, and this can be from lots of people buying in for speculative reasons, or could be because long-term solid performance growth that basically raises the price gradually over time. A lot of companies also pay out a dividend, and this provides consistent cash flow to shareholders. So when you buy Australian shares, this dividend may also come with something called a franking credit, and this is a franked dividend. If it doesn't, then it is called unfranked. Now, the easiest way to think of a franking credit is basically the company's already paid tax for you. Now, unfranked dividend means they haven't paid tax on that dividend, and when you receive it, you'll need to pay the full amount. Now, if you haven't seen my earlier video on ETFs after this, not right now, after this, do make sure you do go check that out. But to keep it brief, an ETF is a bundle of shares or bonds. It's basically like a little hamper basket. Now, it can be domestic shares, international shares, bonds, mix of any of them. The way you generate return on ETFs is the same way as shares. Over time, the price of the market as a whole goes up, giving you a capital return. Now, they also pay out a distribution. This distribution, it can be franked, just like Australian shares, can be unfranked, and it can also have a capital component. So this capital part is basically the ETF sells some underlying funds, they make a capital gain, which they then pass on to you. Great, now that was a quick one, so now we can move on to bonds. What is a bond? So there's really two types of bonds, corporate bonds and government bonds. The easy way to think of bonds is debt. So when you buy a bond, what you're doing is you're giving money to a company or a government and saying, here, spend this money, pay me back at some point in time. This could be 6 months, 12 months, 5 years, longer even. It really depends on the terms of the bond. Now, there's a few terms you'll need to know here. I will make a future video that goes into a bit more depth about bonds specifically, but the basics are that bonds have a face value. So that's essentially the purchase price of the bond. So let's say you pay $100 for this bond. It's got a face value of $100. This part here can get a little bit confusing, and that is the terms for coupon rate and yield. So you can think of coupon rate as the basically interest rate on the debt that the entity will be paying you. So let's say the coupon rate is 5%. So this means that because the face value is $100, they'll pay you $5 every single year. until the entity, the government, or the corporation pays you back that $100 that they borrowed off you. Now, the coupon rate is consistent. The yield is not. And this is because the price of the bond can change over time. So the coupon rate doesn't change because the bond will always pay $5 a year to maturity. The yield changes because the price can go up and it can go down, but the face value doesn't change. So this can be for a number of reasons. Let's say the RBA increases the interest rates. In that case, the bond will then go down, which means that the yield will go up, or the RBA decreases rates. This means the price of the bond will go up and the yield goes down. So the amount that a bond will actually pay you is determined by a whole range of different factors. Risk factors is probably the major one. High risk corporate bonds, such as junk bonds, these are very high risk corporate bonds. They have a very high coupon rate, while very safe government bonds would have a very low coupon rate. And the coupon rate for low risk government bonds would align very closely to cash rate of that country. Now, you generate a return with bonds through basically the coupon rate you receive. If you trade the bonds, you might also get a capital gain if you were to buy it before the rates drop and the price of the bond goes up. But this is not really the main way that people try and make a return on bonds. It's mostly through the interest repayments they get paid. The final asset class I'm going to talk to about today is property. There's two different types of property. You've got residential property and commercial property. I don't think I need to go too deep into property. I'll probably make a future video on this, but in Australia, we love property. And this is basically the go-to asset class for every investor. So a lot of residential property is actually speculation. People think, in 5-10 years, more people want to live in this area here. So I'm going to buy the house, buy the land, mostly for growth purposes. I'll rent it out in the short term over the next 5-10 years. And, hopefully I'll sell it and, make a lot of money on the capital appreciation. Now, the main reason that residential property is fueled by speculation is because of something we've got called negative gearing. This means that high income earners can offset losses that they earn renting out this property with their income that they earn from their day jobs. Now, this ends up reducing the amount of tax that they have to pay to the ATO. Now, as I mentioned, rental income makes up another part of the return for property. Specifically at the start of the ownership period, it generally tends to be like a loss-making venture. So most people use this loss to offset their income. But over time, this does end up turning into profit because rent tends to go up, whereas the expenses will stay the same, or sometimes if interest rates go down, they will drop. The other type of property is commercial property. And the easiest way to get involved in this is basically through a REIT, which is a real estate investment trust. Now, these are listed investments. You can buy them on the stock market just like you can with stocks and ETFs. A REIT will hold a few different commercial properties. Now, this limits the vacancy risks if they only held one property. You can hold commercial property personally, but that's a whole different kettle of fish. As I said, most people aim for capital gains on the return that they get for property. However, as you guys would know, if you were to rent, landlords, they do receive rental income for these properties that they own. So hopefully I've been able to give you a bit of a better understanding of the different types of investments that are available and the broad way that people try and make money from them. If you do have any more questions, please feel free to drop a comment down below. I'll answer if I can. And thank you so much for watching. I'll see you on the next one.